Hello everyone. Welcome. Welcome to our free educational webinar for today, Making Money with Trade Sequences. My name is Frank Ochoa. I am also known as PivotBoss. I am author of the book Secrets of a Pivot Boss. You can find me at pivotboss.com and also in our PivotBoss trading room every single day. I do want to invite you next week as well. For those of you that are part of Swing Trade Pro 2.0 and will become new members here, we will be hosting a free live sessions trading with Swing Trade Pro 2.0, and we'll talk about that a little bit more. So for those of you that already have Swing Trade Pro 2.0 or will become new members here, we have live trading sessions that will be next week. But first, let's talk a little bit about making money with trade sequences. First of all, we have a fantastic educational webinar here for you today. We're going to be dealing with the Rejection Day Trade Sequence and how to engage that to make money in the market when you see this pattern. We're going to talk about it as a part of our Swing Trade Pro 2.0 training. And before we get started, I do want to bring over here our website here for this flash deal. This is pivotboss.com/profits. This is where you came here to find the link and the current webinar, which now has 0 seconds left in the webinar because we are currently in it at the moment. And the purpose of today is to use to learn and then use one of the blueprints that is presented in our Swing Trade Pro 2.0 training. It's perhaps our best training available for swing trading and the only trading that we have that includes options trading as well. And you can see right here we do have a deadline coming up for this flash deal. It's regularly $6.97, which is already a great deal, and right now until May 14th, which is Sunday, you have a flash deal right now of $4.97. That's 29% off. And what's great about this is as soon as you pay here and become a member, you already have access to the on-demand training, which is the bulk of the Swing Trade Pro 2.0 training. In just 10 short hours, you could be trading like a professional trader. And what do I mean by that? It means being able to be disciplined to find the opportunities that you know and like to trade. So we're going to talk about those opportunities, one of which today is the Rejection Day Trade Blueprint and also the Rejection Day Trade Sequence. And then you're also going to manage your risk like a professional, knowing when to put on the gas, knowing when to pull back, knowing how to stack your trades or scale in or scale out of your trades, and of course also managing risk through the way you engage options. So the options market can help you trade like a professional as well, so that you can manage your risk according to each opportunity that you trade. Now additionally, you're going to get that 135-page Swing Trade Pro 2.0 PDF, which has all of the blueprints and all the content in one nice tidy PDF ready to go. You also have recorded live sessions from prior live sessions events, and we're going to have another one coming up next week. And all of this includes future live sessions as well. So you pay once and you become a member so that you can jump onto the live sessions when we do it a couple of times a year. All of this, keep in mind, 30-day, 100% money-back guarantee. But I believe that you're going to love this content. You can learn more about that. You can bring up the page here to learn more, and it's going to bring up the actual longer form page with regards to what you'll learn and the content you'll learn. But for right now, we'll go ahead and get started with our Making Money with Trade Sequences webinar here. The first thing that you'll see is the 5-step swing trading blueprint. What does the 5 steps mean? It's basically engaging the market from these perspectives. Learning to manage the risk like a professional, so basically setting your risk parameters. The trade sequences, these are basically the blueprints that help you find the opportunities you want to trade. We'll be discussing one of those and learning one of those today. Your strategy toolkit is number 3. This is basically choosing your options trading strategy to take advantage of the opportunity that you're trading. Execution would be number 4, knowing how to get in and out of trades, scaling out, scaling in, and managing your positions along the way. And then documentation would be number 5, understanding which trades you're good at, understanding which entries you're good at, which ones you need to get better at and learning from those results. So again, that's your 5-step blueprint there. And again, all of this content in 10 quick hours, and the 100 plus page PDF gives you all of that right at your fingertips, so that when you see a trade setting up in the market or you see some rejection day developing, you can pull up the blueprint and understand the points of entry along the way. So let's go ahead and talk about that rejection day blueprint. The rejection day blueprint here is basically a wick reversal type of pattern, right? A big hammer type of bar. But let's discuss the characteristics of this bar right now. You see it tend to develop in all time frames, and that's what's great about what we do here at PivotBoss. A lot of what we teach, a lot of the indicators we use, the proprietary indicators, the proprietary blueprints, all of these can be used in any time frame you trade and in any instrument you trade. Whether you're trading the ES or Bitcoin, or you're trading Apple, or you're trading whatever else, crude oil. These patterns and the tools we use for them all play out in any time frame and in any instrument. As long as you got a great auction, you're going to be able to engage these patterns. What we're looking for here is a high range day. That's number one. Number one, you want a huge high range day, typically speaking, when you're discussing rejection, because rejection would be a massive move perhaps in one direction, down first, and then once you see a huge rejection of some sort, you tend to reverse back up, and you would then see perhaps a failure to hold beyond a certain support level, for example. Typically speaking, these rejections will happen at the edges, at CLVNs, for example, previous high lows, those types of things. If you have a rejection like this that happens at the center of a range and you've been sideways, it may not mean as much. So the more you can get to an edge or an extreme, the better. The 10-day average range would be a baseline. Typically speaking, when you have a rejection day, it will be greater than, say, 125% of average. So at least 25% greater range than normal. But many times you'll find that a rejection day can be way, way higher than that. The bigger the better. If you have a 200% of ADR rejection day, it's going to be a massive day that likely swings you in the opposite direction. So the bigger the range, the better. But not clown shoes big, right? You're not looking at something that is so tremendously wide that it throws off the auction. Somewhere, as we said, 125 to 200 can be a tremendous size range rejection day. Now, where are the entry points? The entry points, again, it depends on what type of duration trader you are, but when you have a massive rejection day, you tend to see on the low, you tend to see some significant reaction happen, and you tend to back off those lows very quickly, perhaps forming higher support on an intraday basis. So if you know that low may be in, maybe this low also coincides with the rejection of the previous week's low or the previous month's low, for example. If you know early on that might be in, you could play for a day trade higher and look for price to recover the midpoint and close higher for a V-bottom reversal type of day. So that would be the day trade idea. But when you're looking at a rejection day from a swing perspective, meaning this strong low is likely to hold for the next, say, 1 to 5 days, or maybe over the next 1 to 2 weeks or more, then you want to let the close of the day come, and you want to let this day continue to finish in a positive direction. Too often you may get a great rejection, but by the end of the day it fizzles, and now you've no longer gotten that rejection. So if you're looking at this from a swing perspective, you got to wait for this thing to close the day and confirm the rejection and confirm the healthy close. Once that happens, your first entry could be in the final hour of the day as you look for this thing to continue onward. But it could also be, for example, the next day, right? So the next day would be the midpoint here, and that's the point that must be held by bulls. So the midpoint is kind of the the point where a failure can occur, or it can be heavily defended. And so when you have a rejection day of any magnitude, the midpoint is where that pattern fails. So price can come up to it, and then you likely see it bounce and then continue higher. Sometimes price can go below it, and then you see a trap, and then you see it go higher. But if price goes below it, and then it closes below it for the day, that rejection day is broken, and 9 times out of 10 you go take out the low. So that would be a failed rejection day, a failed absorption at the rejection day midpoint, opens up a big failure, and now you go much lower. That's a great tradable pattern as well. So just because you have a bullish rejection day this way doesn't necessarily mean you have to play it for the upside. Sometimes you may think, you know what, that's going to be a failure, or I'm going to look for it to be a failure. And we actually did that here recently as well. You know, you're getting some of these moves that are creating great rejections here, but at the same time, you're not able to get much higher. In a downtrend, that could tend to fail. So that midpoint can open up a great opportunity in both directions. So that would be a great rejection day. The other thing here is, in terms of where you close a great rejection day, you want it to be in the upper third of the day's range at the very least. At the very least in the upper third of the day's range. But it's better in the upper quarter to upper 10% of the day's range, right? The closer you close toward the high, the better rejection it is. If price closes a rejection day and say it's, you know, the close is here instead, and it's very close to that mid, it's not the most significant reaction, right? The farther you get away from this midpoint and close beyond it, allows for a better opportunity that the next morning's pullback holds into that zone so that you can finish with a check mark day up. So that's the idea right there. So that's a bit about the blueprint. If you go over here, you know, this is an opportunity from a few years back, but this is a great opportunity that displays all the various characteristics that we talk about. And so when you look at this, the first thing you'll notice on this opportunity is when price breaks through support. You have a massive support level here at 160, and you bring it across, right? Price had not been above that level or below that level in a while. This is the one massive push through it. Price broke significantly below that level, getting to 156.5, and then price then rejects those lows and finishes the day strong. Okay, so now this is a massive rejection day. It's a massive rejection day in that the range is quite a bit bigger than average. So right there, it's already a big day. Number two, look at the close compared to where the mid is and in relation to the overall day's range. It's in the upper 10% of the day's range or less. That's bullish. And then you look at the reaction of the actual level. This was support. That was our noted key level before. Price broke down through it and then reacted way back above it, closing 3 points back above it. The midpoint now lines up with the level, and now that you've seen this tremendous rejection, there's a couple of things you can do. If you think that you really want to be in, and there's the potential for this thing to pop right away at the open, then there's a shot to be in at the end of the day. So in the final hour of the day, you can execute an entry to be in. But there are times where you may want to be in before the entry, maybe ahead of an economic data point coming out, or maybe ahead of earnings, or whatever the case is. But there's some times where, or many times, most times in fact, where I may say, you know what, this finishes the day strong. Now I want to be a part of the morning pullback the next morning. If price pulls back the next morning and hits my zone, I call this the absorption zone right there. That could be your entry for a continuation up. Remember, you're looking for that check mark day up. That's what you're looking for. So when we scroll to the next day here, this would be the next day's blueprint, the absorption day. So an absorption day would follow a rejection day. You get a massive rejection day here. The next day pulls back in the morning and ideally hits your zone by some degree and then starts to find rejection on those lows, that can be an entry for what could be a continuation back up for the day. That's your check mark trend day to the upside, and you look for price to finish higher. Now in an absorption day, this might just be a trading range day, but each time it gets on these lows, it's basically being defended and absorbed off that area for a continuation higher off of this rejection low, right? So rejection days tend to be high range days. An absorption day tends to be a lower range day, something lower than average, maybe lower than 75% of average range. But the midpoint here is the key level that must be held on a day like that. And there's a couple of things here. You know, if this is your rejection day one, remember you can be in on a swing basis in the final hour of that day. You can be in the next morning on the first pullback into your zone, or first couple of pullbacks into the zone for an entry that way. But then on day three, you can also be in as a result of a failed new low off the prior session low. So if price comes down here, there can be an opportunity to trap below and be in on this day, ultimately for a continuation up. So there's multiple areas here, and so that's the big thing about these blueprints that we discuss, is knowing where your entry points are during a sequence. A bullish sequence up, knowing where your various entry points are along the way, because just say you're not a swing trader. Maybe you're not a swing trader, but you understand the swing dynamics, and you understand that the best entry might be here for a day trade. So when price, after a big rejection here, you want to be a day trader tomorrow. Okay, well, this might be the best zone, so you come down here, you watch for your rejection, you're in long here, and you hold your day trade for the end of the day, and you're out by the end of the day. But you got a part of the check mark day at the swing entry. Okay, say you're not a swing trader, but you want to day trade the next day. Well, the next day here, that low is going to be the best entry. So if price comes down here, you look for rejection, enter on a rejection of the low, you snap it back to the midpoint and across the range. That's your day trade. Say you're a scalper. Understanding this blueprint, right here, you scalp it to the mid or scalp it back to VWAP. That's your scalp play. So while this is called Swing Trade Pro 2.0, these concepts, just understand that these blueprints can be used by anybody in any time frame in any market. Understanding these blueprints, these could be 60-minute bars right here, and you can use this 60-minute rejection and work off of it in the next 60-minute bars. These could be monthly bars, weekly bars, right? So just because it says Swing Trade Pro 2.0, understand these blueprints can be used in any time frame in any market, and again, that's what makes them powerful. So now let's go on to the next day here. Here's your massive rejection day at the level, big rejection. Now the next day, it actually pulled back and approached the midpoint. This is a kind of a freeze in time right there. So this is where it was at that moment, with a snapshot being a retest of that midpoint right there. Keep that snapshot in mind, because that's not what the end of the day is going to look like, right? When you talk about a rejection day that looks like this, and here's your midpoint, and we talk about the next day maybe starting the day downward early in the morning, finding support, and then finishing higher, that means the bar is going to end up looking, you know, kind of like this, where you have a tail here and you finish up here. But right now, that's not what we look like. So in terms of pattern recognition, understanding that when you enter a trade, it will look like this many times. It's going to be down heading into that zone many times. Or maybe you're starting to find a tail at the lower end, but it's still down because responsive bulls are defending. And then by the end of the day, ideally, it overcomes those late sellers and you force a squeeze. So that's the idea right there. Now when you go to the next chart here, you can see price actually pushed down, found a rejection, and look where it finished the day. The trade location would have been say the midpoint or thereabouts, but it finished the day here, right? We were looking at a red bar right here, and it got a little bit redder, but by the end of the day, it closed higher. That's the goal right there, is that following a strong rejection, the early wave of weakness the next day is an opportunity to buy the dip for a strong finish. And if you can finish strong, you get the other days in the trade sequence where this thing can continue to push your trade higher. And then you'll start to see other days pop up. So this is your rejection day, right? This becomes a secondary absorption day. So after this push up, you get an absorption day, which is basically a range bound day that holds the gains, and now you're looking for a failed new low or a continuation through and continuation up. So a great move overall. But the importance here of understanding what this may look like at the time of entry, right? At the time of entry, it's going to look bearish. You look to defend, and you look for this thing to continue higher. All right. So now, let's talk about the failed new low blueprint. This is a quick one here where, again, after you get yourself a bullish sequence, and all of these can be flipped for the bearish sequence, right? But for a bullish sequence here, what you're looking for is for price to make a move to the previous session's low. If price can push through the previous session's low in an uptrending market, I tend to say that that is the best entry on the board. That's the best entry opportunity on the board, is below the prior low of an absorption day in a bullish trend. You watch that prior low, look for the failed new low, and if it starts to reject that low, you tend to see this thing push higher, and it becomes a secondary rejection day on its own, and you can continue higher beyond. So let's take a look at that right here. You can see right here, rejection day, and price rallies for 5 or 6 sessions here. Look at this next day right here where price drops tremendously, takes out multi-day lows, 2 or 3 day lows, but then finishes higher. This is an extreme example, but it makes it even more bullish. This is an extreme example where it takes out these lows but then finishes higher. Again, you have those multiple entry opportunities. You can be in right away. You can be in at the midpoint. You can be in a day later on a failed new low. You know, there's multiple entries along the way. Choose the one you want. If you look back in the chart this way, you'll notice a rejection day 1. You'll notice an absorption day. Then you see a secondary absorption day, which was an inside day. And then what is this one right here? That is a failed new low below 2-day lows at the rejection day midpoint. And then look at the breakout continuation bar and the massive move up. This is a perfect demonstration of this concept as well. And so that's the idea, is understanding that you have a rejection day and maybe a day or two of absorption that follows. Man, a failed new low below these lows here offers the best entry for what could be a snap shot in the opposite direction. So when we go to the next slide here, notice price drops down now. This was actually on earnings. So it dropped down on earnings but responded to the midpoint zone. And then if you pass on to the next bar here, you'll notice that by the end of the day, so it dropped down, by the end of the day it had rallied and then continued higher the next day. And that was the day that I took profits in this scenario here. Each of these were actually traded opportunities. So every single one of these that you're looking at right now was actually traded at those points with these things continuing in our direction. So very nice right there. A failed new low and a continuation up, and you know, a very, very powerful blueprint to work off of. And when you're trending up, you're looking for those failed new lows. When you're trending up, you know, or a rejection here, then you're looking after a fresh rejection. You're looking for failed new lows for a continuation. And then you flip it on the downside. If you're falling hard, that right there is your best entry, and that's a failed new high at the previous session's high for a drop downward. So tremendous how that plays out. If you look right here, this next example, you got your first move up off of this rejection day, held the mid, absorption day, continuation, and then look at this failed new low that comes in right here. Tremendous failed new low, took out multiple day lows, then closed way up, and it's slingshot price the opposite direction. Tremendous move there. Additionally, you had this move up, and then look at price drop below the prior low here. That's a day trade failed new low, and also led to a 2-day move up. So 2 failed new lows in that sequence right there. Now, when you look at a whole sequence, you know, we talked about multiple day types, right? The rejection day, the absorption day, the failed new low day. When you start stringing them together, you get a sequence. You get a trade sequence. And that's what Making Money with Trade Sequences, the title, come from. It's a sequence of these days stitched together. And understanding when those days are developing, but even better, when those days might develop ahead of time so that you can plan accordingly. Okay, this is rejection day 1. So I'm going to look to defend the midpoint the next day. Okay, absorption here. Got to defend the previous low. Got 3-day highs, 2-day highs. We're looking for a stop run day continuation and things of that nature. And being able to anticipate those ahead of time is where really understanding where you can then enter those trades at various points along the way. Again, from a swing trader's perspective, you can be in right away on day 1, but you can also enter day 2, day 3, day 4, day 5. You can add. You can take profits at the end of day 5 and add some back on day 7 here, right? So you start to be creative with the way you use these. So it becomes a powerful blueprint to trading any sequence of days in the market. When you look back here, you'll see again the types of sequences that you see at times. It starts with a big time rejection. Sometimes a big time rejection follows a primary rejection. And off that rejection, you can see how price held the mid and became an absorption day. And then you see a stop run breakout day. And then you see, you know, a continuation. Then you see another multi-day compression develop, and boom, it explodes, right? But all of these days, you'll know how to engage those types of day types and the sequences that they create. Over here would be day 1 rejection. Again, here's your CLVN, big time CLVN. You're in the direction of the up move. It's after a drop. That's a great rejection. You can be in at the end of the day, or you can look to enter the next morning. And some of that really is about how much of a discount can you get. You know, this is a cheaper stock at this moment in time where it's basically a 50-cent pullback on a $29.50 stock. It's not a big deal. So you could be in that day. But if you're talking about a $340 stock and that pullback is going to be about $7, then you know that's a much better reason to hold off for the next morning and look for that discount so you can be in at a better price ahead of the next potential move up. So you can see here the next day pulls back, holds the mid, finishes with an absorption day. Not bad. The days that follow, you know, a higher high, higher low here, but then here's your failed new low. Failed new low in an up move. Failed new low is a great way to go because what follows could be a continuation up, and you see this thing really pop on earnings up there, but a great continuation to the upside. Now, again, we talk about the midpoint being the point of control for a major rejection day or some significant day in the market. To hold that midpoint would suggest bulls are in control. To overwhelm that midpoint would suggest that bears were able to take control and create perhaps a long liquidation. That would create a long liquidation and a sell-off to the downside. Oftentimes, this type of rejection at the mid or failure through the mid happens a little bit higher. It happens on an inability to go up here. So we're looking at these highs and we're like, okay, we need that breakout continuation day. We need that stop run day. And if price fails to do that, it tries but fails, well, now you've created a failed new high. And that failed new high can lead to an overwhelming move through the mid that then exacerbates and becomes a stop run in the opposite direction. And when that happens, and you close below this level, you're going to take out this low 9 times out of 10, and then likely trigger a new failed absorption sequence lower. And then that point that was overwhelmed here can tend to be resistance on the next pullback for a continuation down. So looking at something like this here, you would see this rejection right there. A good rejection, nice rejection of 2-day lows. Notice how the close price is a little bit closer to the mid and not so high up, right? It's got a little bit easier spot to go get that mid. When you drop to the next couple of days, you can see the next day here, price dropped into the mid but held it. So it became an absorption day. Absorption day. So it's still hanging in there. But then here on day 2 after rejection, if this is day 1, that's day 2 absorption, here's day 3. On that day, you're getting a failed new low, right? So ideally, you get that failed new low and you work your way up. But if it starts to fail here and you're failing to get above that mid, that's where the inability to hold occurs and you start to drop, right? At that midpoint. And that's what happens here. You see right there, it closed the day below the mid, the next day failed new high, outside day down, stop run day, and now you've triggered a long liquidation after these bulls were trying to hold it. So that's what a failure would look like in this case. A tremendous failure. And that continues to lead to weakness for a while longer in this scenario. So you can see how that played out. And now you've triggered a bearish trade sequence and you look to engage it from the bearish blueprints. So quite bearish here how that plays out. Now, if we talk about some of these opportunities and what we've seen in the current market, one of the most recent rejections happened in crude oil here recently. And for those of you that were a part of our monthly market outlook last Wednesday, Wednesday the 3rd, we were discussing crude oil and we talked about crude oil and we were basically right here after a 2-day dump. We mentioned before that, during that session, mentioned, okay, we likely need to go take out this low and hit 64s. But what happens then? If we rejected 64s, we may snap back up the range towards 76 and maybe go back to break even on the year at 80.5. And then a little while later, maybe 30 minutes later, the market reopens and drops significantly. I see it out the corner of my eye. It was as we're discussing a different chart, and I mentioned, wow, we've just rejected here. The 64 is really hard. And we snap back. The next day, we kind of hold on to those gains, and it finishes with a rejection day 1 blueprint there. So rejection day, a day 1 rejection blueprint at a significant edge. And the idea was, if we can hold this midpoint now in any pullback, we're likely headed higher. And I gave 3 targets. I said the quick target's going to be 72. The high quality target, high probability target, 76. And then you likely finish and get the 80.5 previous year's close. The previous year's close has been a sticky point all year long. And so you've seen how this thing has continued since day 1 rejection, but it starts with a good day 1 rejection, and now you look to be a bullish participant behind it. And this one continues to be strong. Notice right now, we're inside a 2-day range here, and again, after a strong move, I would say prices below 71 here could be a tremendous buying opportunity if tested tomorrow. If tested on a Wednesday and we drop below those lows, that could offer a failed new low and a move up that takes us into 76s, right? So great day 1 rejection just a bit ago and a continuation so far. But this one's been the king right now of rejections within this market structure. If you go back, even back to last October, November, rejections here, rejections there, these strong rejections at these edges. Most recently, we had this failed new low, day one rejection. Then we had the failed new low here, which was the secondary rejection and led to this move up. Another failed new low right there, which led to that continuation. And so a lot of great day one rejection days here that's developed in crude oil. And the current one right now still suggests more upside to 76 and across the range. So big time strength out of crude oil, and it all occurred off a day one rejection right back here. So those are some recent examples there. If you look at something maybe like the ES, for example, there's been some great recent day one rejections as well. One of them was here off this higher low. That was a fantastic one right there, where you got a failed new low that took you through the previous day's midpoint right here. Absorption day that followed, and that's the failed new low that triggered this huge move right up. So that sequence right there was tremendous. But what was advanced, about this one was that this was a failed new low, day one rejection that took you through a previous day's mid tail event. So initially it was a hard move down, and then it shook back out and went. So tremendous day one rejection there. And in this webinar, again, we are discussing the rejection day blueprint, rejection day trade sequence. But for Swing Trade Pro 2.0, we have a ton of blueprints with all manner of style of rejections. So there's all different types of rejections at these edges, and each of those are documented with blueprints. This is what we're going to use next week as well. So a tremendous move here when you get a day one rejection. We've seen it here before. But again, I do want to invite you to join me here at the pivotboss.com/profits for our next event. So if you like this event here with the day one rejection and the rejection day trade sequence, again, you can learn a ton more about the various blueprints we have over here. If you go right here, Swing Trade Pro 2.0 will teach you trade with precision, choosing a strategy and managing the risk, right? So how to identify opportunities, how to engage those opportunities with options, and how to manage your risk. But if you look over here, I mean, it has a tremendous amount of material all at your fingertips. You're going to find 9 different blueprints right here to find opportunities in the market. And you're also going to learn exactly what you need to know to trade options. If you've never traded options before, this is a great way to learn how to trade options. If you have traded options before, this is right up your alley as well. I'm not throwing anything exotic out at you. These are the way that I trade every single day, selling spreads, buying spreads, and taking advantage of unique opportunities when the chance is there. We discuss it all right here in the strategy toolkit. And again, being able to be creative with your entries, your exits, your scaling techniques, and those types of things, all documented again in a 135-page PDF as well, which is your companion to all of the on-demand training. 10 hours for the primary on-demand training, 20 total hours when you combine the recent live sessions. And again, we get more live sessions coming up. So a lot of great content here. You can take advantage of this right now. $497. That is a steal of a deal. And remember, there is a 30-day, 100% money-back guarantee. But I think you're going to love it. So again, if you do become a new member, you will be allowed to join us here next week. Next week, we're going to have that 5-day live sessions. Basically, we're going to look at some new content here and do some prospecting on day one. And then Tuesday through Friday, we'll jump on during a morning session, 10 to 11:30 a.m., and do some live prospecting, live trading, and look to make some money throughout the week here as we head into a Friday. So we'll get together every single day, 10 to 11:30 a.m. Central. For those dates. If you can't make it, these will be posted immediately so you can follow along. So again, not only an opportunity to learn some fantastic education for a great price, but also an opportunity to join us live to actually follow along and make some money with some of these opportunities next week. So again, a lot coming up. I hope you enjoyed today's content. If you did, let me know in the comments or description here below. That would be very, very helpful. If you like this type of content and want to see more of it, let me know as well. So again, thank you very much for joining me. My name is Frank Ochoa, also known as PivotBoss, author of the book Secrets of a Pivot Boss. If you want to learn more about these flash deals, please visit pivotboss.com/profits. Really quickly here, I did want to follow up on Q&A. Now that we have that nice and tidy on the back end, we have some Q&A here real quickly. For those of you that are still on, if not, this Q&A can be put back onto the site. So, can you give some examples in the live market, Bob? I said, and yeah, we covered that with crude oil, so that was a little bit earlier. Do you have any scans for TradingView in Swing Trade Pro 2.0? So TradingView scans, we do have. That's a great question. We do not have any scans for TradingView, but we do have indicators for TradingView. So I do have indicators for you. For example, our PivotBoss pivots, our PivotBoss advanced ADR, PivotBoss bands, things of that nature. All of our core suite of PivotBoss proprietary tools are available for TradingView. Another one here. Can you suggest which platform to trade, intraday, USD, or versus the ruble? If you have any idea, can you please share? That's a great question regarding USD versus the ruble and which platform you might be able to trade it in. I am not sure offhand right away on that one. That might require a little bit of research, but I'll see if I can find something for you on that end there, RC. All right, everyone. Thank you very much for joining me again. We'll be back at it again soon, and I hope to see you next week for our live sessions for Swing Trade Pro 2.0. Take care, and I'll see you all soon. A couple of more questions coming in. Thank you for those. Are you planning on having any PivotBoss Masters session in the future? Absolutely. PivotBoss Masters is next, and it will be in the couple of weeks ahead. I'll let you know exact dates on that, but it will be shortly after Swing Trade Pro 2.0. Hello, Hemant. Good to see you from India. You use Camarilla for day trading. Is it profitable in the long run? Please answer. Yes. So Camarilla equation is one of the version of pivots that is included in my book, Secrets of a Pivot Boss, one of the ones that I discuss in addition to the floor pivots indicator. As always with these types of pivots, you have to just understand the best time to use them and the best time not to use them, and when and where. And so I still believe that they are very powerful. We have traders in our room that use them every day. Understanding that when you are in an uptrending market, you want to look to defend the pullbacks early for a continuation to the higher targets, things of that nature. Range-bound markets can be a bit trickier with these unless you're looking to fade at the edges. So understanding the various ways to use them in the various markets, it helps a lot. Now, just randomly, for example, fading one of the pivots and saying I'm going to sell this one or buy this one, that one may not work as easily. It's all within the context of what you're trading. And so that's essentially what we're doing as well at PivotBoss in our trading room, is using pivots, but I tend to use our PivotBoss pivots instead, which are based off of the previous high, low, and close of a prior market. So those are the ones we tend to use more of, but the Camarilla ones still work quite well in addition to many of the others. It's just about knowing how to engage those during the right times of markets. What's the name of the toss scan for this strategy? So Sammer is asking about this one. So I believe you may be referring to the wick reversal scan. I will point you to that. And I do have your DM right here up already from our prior engagement, so I'll get you that scan right there so that you can find this in Thinkorswim. Okay, great question here. I joined and I'm wondering how to set a stop loss after entering a position. Is it right below or above a rejection day? So that's a great question. So typically speaking, if I am entering following, so that's a great question here. Let's just bring up the chart again, and let's just pick this one right here. And everyone's a little bit different, right? But typically speaking, if I'm in on a trade here, or I'm looking to get in after a rejection day, where's the low, right? Initially, the low should be below the low, or the stop should be below the low, meaning that if you believe this is day one rejection, then we shouldn't come back to this low. We should move away from it. So initially it's here. But on the next day, remember, we move it up to here and say it's not necessarily a stop, it's just that's the level of inflection that if we can't hold that by the end of the day and say we're in the final hour of the day or we're too much below it, you may be able to just cut it there, right? Because if we end up closing below that mid for the day, that's your cue to get out, because 9 times out of 10 you're going to go hit that low anyways. So a great question, a little nuanced on the answer, in that yes, it's initially below rejection day low 1, the stop that is, but in the days that follow here, you ideally are watching this level, and it shouldn't close below there, because as soon as it is about to close below there is about the time where you want to jump ship. Now, as the trade continues to progress, you start working your way up on the strong pivot lows. So you're working off of this level, then you get this low and start to bounce. On this transition day there, now you're saying, okay, now this is the pivot low, right? As you work your way higher. For me though, I don't typically work, that's how you would typically work your stops. Now for me, when I engage my options trades, I just allow it to work its way as long as it doesn't fail outright. And even sometimes when it does fail, I may add to the position and allow it to come back in the view. It depends on the conviction of the trade and what's happening. And it also depends on which options I'm selling or buying, and the time duration and all that. So that could be a bit different. But for the most part, you're working off of this midpoint and this tail low on the very first day. Great questions there. So that's another great question. How will I select stocks based on rejection day conditions? So number one, when you have a great rejection day, and welcome again from India, Rakesh. I love seeing where everyone's from. I know some of you come from all over to join these webinars, which makes me incredibly happy. So thank you so much for all the support I get from everywhere around the world. Typically speaking, the best rejections, number one, are at the extremes of a range. So right now you have, say, 4,200 as the major extreme here, 3,850 or 3,800 down here. And so ideally you're looking for rejections here, here, and here, right? You're looking at those edges. Or if you get too far out, now you're looking at an edge down here, wherever the case is. So out here. You don't typically want a rejection that's stuck in a range, in here somewhere, because it's in a range, and sometimes you can just get a lot of false signals in a range in the middle of nowhere. That's where some of these it was tough, because we were just kind of getting chopped around in here for a second before we finally unwound to the upside. Right now, it's kind of the same thing here. We're stuck in a range, and it's making it difficult. So if you want to engage the current market, you got to wait for a new high to sell it. Just like here, we waited for that high to sell it. And then when it got to this low, it rejected, time to buy it. Got to this low, rejected, time to buy it. So you have to be at the edges just in general at the moment. But the best rejections occur at the extremes. The best rejections occur at the extremes time and time again. Yeah, great question regarding the lines on the chart right now. This is the chart that I post for the pre-market videos on YouTube. And most of these lines are all either pivot, they're all pivots basically. And so this right here is the PivotBoss pivots, and that would represent the previous high and previous low the prior time. In this case, these are quarterly pivots. Previous close would be here, previous high, previous low. The midpoint would be the thicker pink line. This would be the pivot point and the top of the pivot range for those lines. And then if you get outside of that range, you get the extensions. The extensions go beyond, this is your 25, 50, 75, 100% extension. And then you have the same on the bottom. Now you also see some of these blue lines. These are user added, user defined, and those are based off of FOMC. So those are based on the Fed here. Every 6 weeks or so, roughly, we get ourselves an FOMC key level. It may or not relate to what's happening on perhaps, say, the Indian Stock Exchange, but these types of Fed events for us here leave behind information and a period in time and a reaction to that information, and you tend to see movements back and toward these levels. So sometimes those can clutter up my chart, and I try to remove the past year or so and keep only the most relevant. And then you have these right here. Those are the bands, and you'll notice that there are these cyan bands right here. There's an R1, R2, R3 band. Those are standard deviation bands above value. So this is basically year-to-date value, year-to-date VWAP, volume weighted average price, and then you go 1 standard above, 2 standard deviations, and 3 standard deviations. And you'll notice that these standard deviations are already, they've been kind of normalized already, and that's because we have a proprietary little snippet in there on how to calculate that and normalize it backwards. So that gives us ready-made bands as we move forward. So those are the bands right there. At times you'll see some of these gold levels right here with numbers on them. Those are my key range levels, kind of range expansions. When you have a great impulse move, you can mark the edges, fade the edges, and look for the extended targets. So you'll see those. But for the most part, those are the main levels on the charts. Down here, I'll quantify range with the advanced ADR indicator. And then you'll also see one last set of lines sometimes. And these would be the targets. So, for example, right here. That green line right there, and then also this green line right there. Those are the monthly targets based on average monthly range. So from the low of the month, it'll project a range. That's 100%, that's 75, that's your 100, or that's your high probability target zone right there from the low of the month. Now if it's the high of the month that's in, then you get the same reading to the downside. And that's one way to do those. So those are basically the levels on the chart, and you can go back to this recording here if you kind of want to revisit this discussion. Yeah, so yeah, I know for those of you in the Indian market, Thinkorswim doesn't support it right now, and that may be the case in other countries as well. TradingView is very, very good for that as well, so I know a lot of folks that don't have access to Thinkorswim may go TradingView. I think TradingView's done a good job in that market, and I do offer those tools for that market as well. There's additional tools that can be made for that market, but right now TradingView tends to be a great way to go from that perspective. But love to hear the perspective of others and see what other platforms you might be using as well to support your market. And thank you very much for the kind words regarding my book. You mentioned here, thank you for writing PivotBoss, and I would say thank you very much for loving the content. And again, that content right there, the goal behind writing that book was to write something of value, of substance, and a book that could stand the test of time. So foundational concepts that are not just flashes in the pan, but concepts and ideas that stand the test of time, and then you can build upon those concepts as well. Things like compression leads to expansion. To me, that's a foundational concept of the market that is not going to be gone anytime soon. It was here way before, it's going to be here way after. So things like that. The auction process in general, and then finding rejections and rejection opportunities to trade off of and things of that nature. So again, that's awesome. That's so cool, Rakesh. You mentioned here the book Change Your Life, and I just want to say thank you so much for taking to that content as well. So again, thank you all very much for joining me here today. Again, I would love to hear your comments. You can, when I post this video here onto YouTube, like, share, subscribe, and comment below, and we're going to be much more focused on engaging the social media, especially from the YouTube perspective, as many of you have reached out for more community on that platform. So we're going to do much more here as we move forward. But I want to say thank you all very much for joining me here for this event. This has been a tremendous opportunity to showcase some of the things we have here at Swing Trade Pro. Again, you can go up here to pivotboss.com/profits and jump on this amazing offer. Everyone have a fantastic rest of your day, and I'll see you soon. Take care.